Welcome everyone, and to this webinar, Top 3 Candlestick Pattern Strategies. This is Stavros. Today we'll be going through the 3 most effective candlestick pattern strategies for successful trading. We'll take a look at what these patterns that are involved in the strategies are, how they are traded, and of course we're going to have a look at some of the examples. Obviously we're going to start with some of the more basic stuff first, and hopefully see how we can take advantage of the whole package rather than just these 3 strategies, because everything is important. By the end of the session, I will be hoping that to equip you with the knowledge and the expertise to make decisions like pro traders do. So I'm looking forward to taking you into the slides. Let's get started before we run out of time. So a small introduction to the candlesticks first. So the candlestick patterns, we're not obviously going to see everything because they are just way too many involved. We're going to look at the types of candlesticks and their interpretation, because we need to understand what each candlestick pattern means on its own and what it means in context with the rest of the markets and where it is and the indicators and all that. Major and minor patterns and signals that we should know as traders, how to find reliable and also false signals, because some people think that they're just seeing a pattern and they're like, okay, that's what it is, I'm just going to short the market, here's a reversal, but they fail to identify what is the difference between a good signal, reliable, and a false signal. We're going to see that today, and then we'll talk about the 3 candlestick pattern strategies I will introduce to you today, and some tips for effective candlestick pattern trading, which they're more general rather than specific to the strategies, because we're going to look the specific ones as we go through the strategies themselves. And a conclusion is some time, of course, for some Q&A. Now, what is a candlestick? Candlesticks provide a great visual aid to read and interpret the price movements of any market within a particular time span. It could be the hourly, it could be the daily, or the weekly bar chart, well, candlestick chart. It is composed of individual candlesticks, of course, which is one showing the opening, closing, high and also low prices for a given time period that we select to represent the market for us to view. The difference between the open and the close over here, as you can see, is called the body. Okay, and it's either represented by a filled body or a hollow body. And the colors, of course, are also different. Typically, we see the green or white candlesticks indicate that we are bullish, and red on black candlesticks indicate that we are bearish. That is, of course, in relation to the open, right? Now, how to read a candlestick? When it comes to reading, we have the OHLC sort of acronym that represents the open, the high, the low, and the close. The open, it's the point the market opened, for example over here, typically it's the previous candlestick's close. Sometimes we do have a gaps, of course. I seem to have mixed up the two. That should be black and that should be white, or bullish, open and close, bearish and then bullish over here. The high is the highest point of the market in either case, that buyers have managed to push before the sellers to control the market. Again, the low, of course, is the lowest point of the market. The sellers managed to push before buyers to control. And then, of course, we've got the close, which is the point that the market has closed for the specific time frame that we're looking. And that is actually what determines whether the specific time frame that we have been looking, it's bearish or bullish. Okay, now there is 5 very important characteristics for a candlestick that we need to know and we need to understand and start kind of looking at. When you look at a candlestick pattern, you need to straight away identify these 5 different things. The most obvious is the color. Okay, and as we said before, green is bullish, black or red is bearish. The body size. The body size is the distance, as I said before, between the open and the close. Okay, that is called the body. okay? And its size is important because when it's larger, it suggests that the trend is strong, while when it's smaller, it suggests, of course, that the trend is weak or it's coming to some sort of weakness. The weak position or the tail, if you may have heard, the longer wicks on the one side of the trend indicate the opposite side has more control of price action than the other. Okay, so if you have two wicks, one is on the top, one is at the bottom. If the wick one is like larger than the bottom, it means that, you know, it's more bearish than it is bullish. So we have to take the two candlesticks, the wicks of a candlestick, and kind of compare between them, okay, to identify which one is winning the game, if that makes sense. We also need to look at the wick length, of course. The longer ones typically imply higher volatility than the shorter wicks, and they do represent significant selling or buying in reverse. In reverse meaning because, you know, if you're going to see a spike up and then markets move over the different direction, then the wick length over the top side, of course, is the one that matters most, right? And you have, maybe you're going to have no wick on the other side. That's why it's important to look at both wicks and their length and where they are. And of course, the range is the distance from the low to high, okay? And that shows the degree of volatility in the markets, okay? As in, you know, if the range is bigger, then that signals a bit more noise, okay? And noise doesn't necessarily represent a bullish or bearish or something. It just represents volatility, which means more dramatic moves because volatility, because liquidity is thin. Now, going into the three different types of candles, I like to actually categorize them into three different types: the solitary, the relative, and the pattern. The relative is also a pattern, but well, you will see the difference in a minute. Now, the solitary is the one that is just a single candlestick, okay? It is a pattern indeed, but it's just the one candlestick. And it can be used to indicate a potential reversal or a continuation of a trend depending on the characteristics of the candlestick. So we always need to have the characteristics in mind. Now, a relative candlestick is a type of pattern that involves two candlesticks, okay? And this type is like a combination that compares the recent or the current candlestick, if you may, to its preceding one, okay, to the one before. And that can be used to identify potential reversal or continuation signals. And then we'll get to the pattern, the candlestick pattern that involves a combination of more than two candlesticks, okay? So sometimes it's three, sometimes four, sometimes five. And equally, these patterns can be used to identify, of course, reversal, continuations, and more reliable entry and exit signals and points in any market that they appear, okay? Any market. Now, let's look a little bit more, and I have also some examples here for you, okay? First of all, I wanna speak about Marubozu because a lot of people don't know the Marubozu. It's also known as a shaven head, okay? It has actually no shadow to the top or to the bottom, okay? It has no wicks, and it signals a continuation or a reversal when identified either at tops or bottoms. Now, the bearish Marubozu, which is of course the version you see over here, since it's all blacked out, offers a weaker reversal signal than the bullish continuation, okay, Marubozu variation, just to keep that in mind. Now, the spinning top, we typically see this when markets consolidate or are about to consolidate, or even perhaps at the double top or bottom, okay? It offers no clues when it is in a range. You don't know if you're consolidated whether the breakout is going to be to the upside or to the downside, but there is, of course, a lot of information that you can take from it if you look at it contextually, okay? And that's typically because it has a relatively small body, okay? It can be in good signal in trending markets, as I said before. But as a rule of thumb, you know, the next candle is expected to move based on the close. For example, in this case, we have a bearish close, right? So it is more likely that the next move is going to be, again, bearish rather than bullish. So consecutive candles, if that makes sense, consecutive in terms of the color, right? So if you're going to get a negative close in one case, there are more chances you get like a negative close in the other case as well. And then you have the doji candle, which is not far different. I mean, you can even call this a fat doji if you wish. And this one, it's like the one that has really no body. I mean, in relation to this, it really, you can barely see it. Sometimes actually you just see a line, okay? And that has varying wicks, in sort of like length, but we prefer to have for them to be equal, because when they are equal and because the candle itself represents a balance in the markets, we prefer to see that balance also on the wicks. But if we don't, that means, as we said earlier in the characteristics, that there is either a bit more power to the upside or to the downside. If you have a longer wick over here, for example, that represents better buying power, because markets fell initially, but it seemed like that bulls managed to return the prices all the way up to the open, which is kind of a little bit more important to consider when we are trying to contextualize what is going on here. Now, the relative ones, we're introducing engulfing, harami, and also the kicker. Okay, this is just choices that you're going to understand why I'm picking those soon. Now, the engulfing candle is stick pattern, is the one that is comprised of 2 candles only. Okay, the most recent one has to close above or below the preceding candle's low or high, depending on what it is. This, as you can see, is a representation of a bearish engulfing signal. Okay, and as you can see, we have actually come and closed below the low of the previous candlestick. Okay, below the low or at the low, or sometimes you might see it closing over here. We're going to talk about the differences between all of them and the fact that, for example, here we might have a new swing high versus not. We're going to talk about all of this and how to improve effectiveness in later slides. The other one is the harami. The harami is kind of the opposite of the engulfing candlestick. Okay, it's also known as an inside bar because the current bar, or the signal bar, if you may, it's actually within the body of its preceding, and that is within the body. You see that? We're not talking about the low or the high. We're talking about the high or low, the close or the open. Okay, and then of course we have the kicker. The kicker, guys, is included because it's very effective when it happens. It's not easily identified because, well, when you look at the rules that we're going to look and the conditions that need to be met, we're going to look at those later, but it's appearing very rarely. But when it does, I mean, you should be looking for it when you're scanning the markets. Okay, and that's why it's here, because it has a very high accuracy rate. Okay, now it's also comprised of 2 candles, and as you can see here, the stark difference here is that you have the open of 2 opposite candles at the same level. Okay, so markets went down, and instead to see an open over here and then continuation to the upside, there is a huge jump of the full previous, like let's say day, if we're looking at the daily time frame, right? And there is a gap, and you got the same open, and that signals a very strong reversal. But of course, we need to look at the size of the body. Okay, it's very important. If the size is small, it doesn't work. If we don't have Marubozu candles, because as you can see, then they're both Marubozu, right? Then it's not as a strong signal. So all of these things are going to be important. And of course, the patterns, I've got here a few examples for you. I've got the morning and evening stars. Okay, this is of course the morning star, as you can see, because the doji candle is at the bottom rather at the top. The black cross, which is the opposite to the white shoulders. Here you see the white shoulders, and the white and the black cross is exactly the opposite. And also the 3-line strike. Okay, now here's the thing. All of them are 3 candle patterns, apart from the 3-line strike, which is actually a 4. I mean, the 4th signal, the 4th candlestick is the signal. Okay, it is a 4 candlestick pattern. Now, in this particular case, you see 2 opposing candles separated by something of a doji over here. Sometimes you can get 2 dojis or 3 dojis, but the tri-star is a different case. Okay, but it's important to be able to identify the pattern as it is, and sometimes, of course, it's important to also know the differences about where the prices are closing and how much higher we've gone and all that stuff, and the length and the body of this candlestick versus this one. They're all important things to measure. To the crowd, I'm sure that this is actually the white shoulder sort of pattern. It's also comprised of 3 candlesticks, but in this case they are all like breakout candlesticks. So you see that we have 3 consecutive moves to the upside. okay? And in each case, prices fail to retrace more than 50% of the preceding candlestick, okay? This is the same for the Black Crowes case, of course, to the downside. And three-line strike is a four candlestick pattern, and you've got kind of like wide shoulder sort of pattern, followed by a candlestick that engulfs all of the wide shoulder pattern. Okay, and this is of course a reversal candlestick. It's like, you know, imagine the engulfing case, right? So maybe you're looking at the 4 hours chart, for example, you know, and you're gonna get these 4 candles like coming in, and then this one, the big one, engulfing all of them. But if you look at it on the daily, it looks as one engulfing, you know, and one day that was going up. So this is why three line is here, because some of you, I understand, want to trade the 4 hour or the 1 hour time frame. So when you see things like this, just keep an eye that when you see 3 consecutive candles going up or down, and they are uniform and equal in length and body and all that, then keep an eye on the daily, because these trades usually are actually quite good. They offer very good risk to reward ratio. Now here I'm showing you a quick table of the different types, and with some examples. I have solitary, relative, and pattern, as I said before. Solitary case, we have the Marubozu, the dojis, all different types, the hammers, and also the shooting stars. All of them are solitary. I mean, which means the signal, it's just one candle itself. You don't need a second or a third or one at the back or on the front. That's it. The relative one, you have the engulfing, the piercing, which the opposite of it is the dark cloud. You have the haramis, bullish and bearish, and bullish and bearish kicker. And when we go at the patterns, you've got anything that is more than 2 candlesticks, right? The morning and evening stars, the 3 white shoulders and the black crows. You've got the 3 inside, up and down, and the 3 line strike. Now, for obvious reasons, we're not going to analyze all of them, but the reasons also I am mentioning them, it means that, you know, it might be a good idea to take your own time and have a look online. What exactly is going on with these patterns? What are they, and should I know them if this guy doing the webinar is telling me to do so? Well, now, I want to have a quick look at the major and the minor patterns, of course, and also tell you something very important. Okay, what is, first of all, when we are talking about major and minor signals, what actually separates them? What makes the difference? Well, we call something a major when we are looking at the significance, quality, and reliability, and all of them are high in terms of, you know, if you had a measure from 0 to 100, let's say, right? So major signals tend to be the trigger of stronger moves, which means they lead to a longer term move, which of course then implies that there is much better risk to reward ratio for this particular trade. And this is very important, guys, because major patterns, okay, are major because they are able to provide better rewards for smaller risks. That's one thing. The second thing is quality. And it's not hard to explain this, but the easiest way to contextualize so that you can visualize as well is to think of this as the quality of a signal when you see, when it appears on the charts. Okay, so you see a pattern and you're going to look at the characteristics of the pattern and some things that we're going to actually dig in a little bit later in order to be able to separate the good quality and the bad quality candlestick patterns, whether 1, 2, or 5. Okay, and they should be the ones that respect all the rules and several of the signal improvements that we're going to talk about later. And the other thing is reliability. Okay, when we're talking about reliability, and although this is not, of course, something that we should take in stone, you know, major signals tend to appear less frequently, and that are more reliable, whereas minor signals are best used to identify potential entry and exit levels. Okay, now because a lot of people have the a thought, or maybe have learned or experienced somewhere that the patterns that appear more often are more reliable. This is not the case, because the more often they appear and the more false signals they give, like the less reliable they become. It's like, for example, the kicker signal. It's one of the best examples I can give you. It will appear maybe once in a while. Imagine you will be scanning the markets, for example, stocks, indices, forex, crypto, all of you have like at least 200 markets to you have to pick like 10, 20 assets that you're going to be following on a daily basis, because otherwise it becomes a full-time job of scanning. You're going to identify so many engulfing signals, so many Harami signals. You need to pick the best, identify the best out of all to trade, right? But it's not going to be so typical to see the kicker, but reliability for kicker is top. Now, few of the examples of the major patterns you have, of course, the dojis, all the different types: long leg, gravestone, dragonfly. You call it bullish and bearish engulfing, bullish and bearish harami, the morning star and the evening star, and also the shooting stars, the hammers and the hanging man, and the pacing pattern and the dark cloud cover, and as well as the kicker signal. And now you also have continuation signals that they can be major. They can be called major, not because they are there and tell you it's a breakout and markets are going to go higher or whatever. It's because continuation signals, guys, or patterns, they actually there to tell you that the market is currently resting and we're going to see a continuation into the predominant trend of the market. And this is the moment that you want to be in the market, okay? Either, typically, and we're going to see that as a tip, you do that before the breakout or after. Sometimes, people have hard time choosing which sort of risk profile they want to because it's a risk profile they want to use. Some people decide to enter the market before something happens, so that they can take advantage of most of the breakout gains, which are the biggest, I would say, major in most of the cases. Whereas other people wait for the breakout and the confirmation and the validation. This is something for you, of course. I cannot tell you what you do on that end, but we will, of course, talk about the strategies, and I will tell you how and what I do to enter and exit the market. Now, these are two candlestick reversal signals, and they are major, and that's why you are seeing them. The engulfing, the harami, and the kicker. You probably realized earlier that this is going to be involved. These three are going to be involved right now. Here's the thing: the engulfing appears after continued trend and an open of the candlestick, suggesting further depth. Okay, markets reverse rapidly to engulf the whole directional candlestick. Okay, reverse in psychology and the trend. So look at this, and I have actually highlighted two things here. One is that we do a little bit, even a tiny bit of like an inch or a peep above the previous candlestick high. It's very important because we take the last stops. We liquidate everyone who has put their stop losses there, and this is important for the markets, okay, to move next. And then what do you see? You see a close, and that close is also below the low of this particular market. We are looking at a bearish engulfing, by the way, right? Just to make it clear. But these two things are very important, guys, because sometimes you might see prices going to here and not closing, not tapping the new territories over here, and you might see the candle closing here, which is above the low. These are the signals that we're going to talk about that are not as reliable. Now, when it comes to harami, the harami also needs to come after a continued trend to the upside or to the downside, and it has to have an open that suggests a slowdown in this case, right? And the markets move against the directional candlestick, but without covering the full range or convincing of a reversal. And what is not convincing of a reversal? Not convincing is what you don't. We're not talking about the low. We're talking about the open. Prices don't even actually close or go during the hour or the day below the open. And the same applies for the upside, not being able to go above the close. Okay, as you can see, that's exactly what the inside bar means. It's covered or it's engulfed, let's say, by its preceding candlestick, whereas, this is the other case over here, So imagine this opposite, and it is important that we actually don't go above or beyond or below the body the body of the preceding candlestick, because this is what enhances the accuracy of the pattern. And of course, the kicker, it can be after a continuing trend and has an open suggesting a reversing breakout gap, as you can see, at the directional candlesticks open, which is over here, right? And that is flipping investor sentiment to the other direction immediately, and that is why it's a very big signal to keep on your charts, you know, as a pattern to trade and to provide signals. It's very important. Now, let me tell you about the kicker. It can appear anywhere. Its significance is actually very big, whether you see it at the end of the trend or in the middle of somewhere, okay? Whereas Harami and engulfing, they do a better job when they are at ends, okay? And we will see how we're gonna identify those. Now, before we go to the next slide, I wanna tell you about some general rules and improvements, okay, about the candlestick patterns, okay? First of all, we're talking about characteristics, right? Where is the open, where is the close, the low, the high for a specific pattern? It's very important to look at all of those characteristics that we identified on slide 3 or something. We need to look at the length of the body, the range, and the wicks relative to the preceding candlestick, and even other, if other wicks are equal, if there are any wicks, of course, right? And we're not just talking about the preceding candlestick. Of course, based on the candlestick pattern that we look, it might be 3 or 4 or 5 candlesticks involved, right? We need to pay attention and look at each one of them. What is a defined trend, which is very important? Are we moving up in the longer term or down? The colors of the candlesticks involved in the pattern, you know, are they the same color or are they the opposite? Is the signal candle engulfing? And if yes, how many candles does it engulf? For example, in the engulfing case or the Harami case, you know, do we have a second Harami? Because sometimes you might get an inside candle inside another one inside candle. You know what I mean? So you're going to have that thing kind of turning into some sort of you know, pyramid that has fallen to the to the right or to the left, well, to the right, yeah. So this is important. How does the following candle look as well? Which is the confirmation candle, by the way, which I don't wait in most of the cases to happen, because there is two things that you need to remember. You have the preceding candle. The current candle is typically the signal candle, and the confirmation candle, most of the times I use the signal candle, but it's the candle after, okay? But we're not going to look at that much today, I think. And of course, if there is a gap, okay, and between which candles of the pattern, because sometimes it's important to have a gap. For example, in the morning star, you know, it's apparently more reliable when there is a gap to the downside in the doji candle, okay, and then you have a gap to the upside on the follow-up candle. So, you know, and some of the kind of improvements that we can use to scan, to just separate the good and the bad signals, let's say. We look at the gapaways, okay, whether it comes with volume or whether when it comes, we are in an oversold or overbought condition, and whether the gap is towards or against the main trend. We need to look at the volume during the large candles, and also whether the confirmation of the signal candle break the previous low or the previous high, okay. If there is volumes in both candles, and how much is one over the other, and you know, we need to understand why in one case it must be higher than the other and all that stuff. The size of the candle, of course, and where it is positioned. How deep did the signal candle go into the opposite territory? Okay, sometimes we just retrace. Sometimes we just don't go over the 50%, as in the case of the white shoulders, for example. And it is important because you know what to expect. The size of the wick against the reversed triangle, and all the candles close near to one another, and which of them are lower or higher, and are candles equal or uniform between them, for example, in the white shoulder case again, right? Now, I'm not going to go into that much, but we need to talk about the minor signal patterns as well, right? And what matters really here is the importance, the effectiveness, and the timing, okay? Some of the examples before, you've got the 3 and the 2 black rounds, then the white shoulders. They are minor signals, yes. They have the 3 inside up and down, 3 river bottom, 3 stars in the south, tri-star, meeting the lines, concealing baby swallow, and also the stick sandwich. Okay, all of them are not as important, of course, but you will see why we should know them and know what they look like soon. First of all, terms of importance. Minor signals tend to be found in the shorter time frames, okay? And they offer better confirmation signals than risk reward in this noisy environment, of course, okay? That means that we need to, it's better if we use the minor signal patterns as confirmation of a particular move or trade that we want to do. Effectiveness comes down to the accuracy and speed of minor signals lack, okay? But they do increase short-term trend directionality, which is the reality. Okay, and also timing. Typically, minor signals appear next to major or other minor signals. And these sometimes can alert traders to what might happen next. As I said before, I said it probably the third time I repeat this, context matters a lot when we're talking about candlestick patterns, because I see a lot of traders failing to trade them, and they are so reliable because they do not know how to identify the good from the bad. So why do we want to use continuation minor signals, right? There's mainly three reasons: observe, decide, and confirm. Observe, since they indicate either the continuation of a trend or a less frequent pattern, they can be used to manage risk and the trade itself. Number one. Number two now, when they appear, they provide you the time to think about the next move you want to do, whether you are in a trade or you're thinking of entering a trade. But most of the time, and according to my experience, of course, they are used to cut losses short. So I'm trading something, oh, I identified a signal, oh, I'm getting in, boom. Then I see a continuation or a minor signal. That tells me, oops, something is off here. Then I'm gonna cut it short straight away. It's important to manage both profits and stops and loss, yes. And third, confirmation. Apart from providing an actual signal to remain in a trade or to cut one short, they also allow you to confirm an upcoming pattern's directionality when they appear either before the signal pattern or even after. But when we're looking at before, then this is mainly a confirmation that the signal that you have just identified it's more reliable, it has more chances of success. Now we are going to talk about the reliability now of the signals, how to find the good ones by the bad ones and the good ones, but first it's important to talk about how we can analyze signals, right? And there is a four-wave process I'm using: identify, evaluate, confirm, and manage. Identify is the most important, of course. Without knowing that, there is nothing we can do with candlestick patterns. That is the ability to identify the signals, and improves when you have a rule-based system for optimal trading. For example, the rules and the improvements I'm going to talk about. Number two, evaluate. The signals involve the pattern and how effective they are, which in turn involves a process of analyzing using the indicators, because it's not possible to just trade candlestick patterns on a standalone basis. You cannot just look at a candlestick pattern and say, I'm going to go into the market now. You need to evaluate with other indicators, okay? Evaluate how good the trade is or the pattern. Confirmation, it's a different type of confirmation from the one was before. This is the prospects of a good trade, and how they can increase when you are able to identify false signals. And confirmation should be part of the analysis or of your trading system, if you may. Okay, so we look at the pattern, we find it, we evaluate with indicators, and then we see if our rule-based system actually meets all the requirements. Is this the pattern that we're looking for? Is the oscillator or the volumes are showing us exactly what we need to see? Are the characteristics of the signal, if the specific particular pattern respected here or not? And finally, of course, manage, and that is once you are in the trade. Okay, build a risk system that exploits all the candlestick information before entering a trade, and that allows you to monitor the progress of the trade. And that's why we want to incorporate the minor signals and the continuation signals as some sort of confirmation for our trade, as well as to manage the trade, because if something appears, we need to cut that thing short straight away, that is still part of the management. Or if we identify the first take profit and the second take profit, it might be because a new pattern appeared. So we need to always follow the progress of a particular trade. And this is how to find signals now, which is mainly related. I would say it's a mix of, identify and evaluate. Positioning, first of all, where is the market position relative to its predominant trend? Okay, it's very important. If we're near a turning point, the prospect of a trade the process are much better compared to when the market is, for example, in an extended rally or something. Okay, what does the stochastic indicator show? I'm using the stochastic. It's the best indicator you're going to use to identify turning points. Okay, and that's why it's the most important. The RSI, it's not. Yes, it oscillates, but you're not going to get the same accuracy as with the stochastic. If the trend is overextended, it makes a better case for a reversal signal all the way to the opposite side of the oscillator as well. So you can use the oscillator to identify potential take profit levels and perhaps even, stop losses. Precedence. This is not always the case, but sometimes it's there. First of all, do you recognize a preceding formation, right? And what is the post-pattern reaction? To give you an example, let's say I'm looking at the chart right now and I'm seeing an engulfing pattern, but then I'm looking 5 candlesticks back and I see another engulfing pattern, but didn't play out. That's why I need to see the post-pattern reaction, because if it didn't play out then, there's more chances that it won't play out now. Or we need to identify why it didn't play out. For example, we need to confirm, which is the next step. Okay, what does the signal and the candlestick tell you? The following candlestick. Okay, when a pattern is expected to play out, the signal and the following candles act as confirmations. That, of course, includes the volumes. It's not just the only thing, and the volumes should be looked at both indicator and confirmation stage. And then we're looking about the timing. Now, the timing, I know some of you might not be using, because you might be trading the 1 hour or the 4 hour, which means you need to look at the time. But if you trade the daily, it doesn't make much difference, because the close pretty much involves all the session. So if you're trading the 1 hour on the 4 hour, you might see a pattern appear on the Asian trading, or during Australia, or during London, or whatever. This matters, okay? Because the if market is not as liquid, let's say outside London, like in Asia, or even New York after London sometimes, then that is not going to be as reliable, because you need the liquidity to have this play out appropriately. Okay, and don't forget that. And this is also why I'm telling you that anything that less than an hour is quite noisy. Even the 1 hour is noisy, unless if you are trading London, okay, which is okay. But then the main point from this is this: the most reliable for candlesticks is the daily. Okay, the daily time frame. That's what you want to use. Now, I want to give you an example here, and based on this position indicator, precedence, confirmation, and timing. Let's look at this. This, for example, it's like euro pound on the daily, and you see we have, what is this, guys? Is harami, is the inside bar. This is a bullish harami pattern. Okay, and look, if we look at the positioning, we are actually kind of at the bottom of the trend, right? So position says yes, this is a good trade. But then if we move to the next page, and I actually show the indicators now, look, the stochastics has already turned. It's already in an actual positive territory, right? It's in positive territory, I repeat. And the volumes on the inside bar are much smaller than the preceding candle, much smaller, right? So let's look at this. Now, what does this mean? Well, look, you see, and let me explain. Precedence says no. Yes, the trend is bearish and we are at the turning point, correct. But the volumes are very low, important to remember. The stochastic is already like, in kind of outside of our oversold territories. And also we have precedence here. Look, you have another engulfing pattern, another harami pattern here. You see the harami? And you also had low volumes here. And actually, the stochastic was even in better position, and still it didn't play out. Okay, and here's what happened next. We went up, but we came all the way down here, and we took out all the stop losses from here. Okay, so which one you would have preferred? You would have preferred to not pick that trade. Okay, this is kind of one of the only ways we can identify false signals with with valid signals. We need to use the oscillator, we need to use the volumes, we need to look at the volumes at both candles, we need to look at where has the signal candle closed relative to its candlestick pattern, of course, and the preceding, if there is any precedence, what does the trend tell us, and all this. This is 5 key things, guys, and without having ticked off every single one, it's a no trade. Okay, and this is very important. Now, the major strategy signals, and these are the strategies we don't want to talk about, guys. Bullish engulfing and bearish, bullish harami and bearish, bullish kicker and bearish kicker. Okay, bullish engulfing forms after a downtrend, and it opens equal or lower to the preceding candlestick, and the closes near the high. Okay, and this open close we shouldn't have both. What it means that if you are gonna like go down and close over here, you should have at least done a fresh high. But if you close below the low, it doesn't matter if you have done a fresh high. Okay, that's what I mean. We can get one of the two, but if we get both, it's a much better case always. Of course, the opposite is the bearish engulfing. In bullish harami case, it also forms after a downtrend. Okay, so we need to have a downtrend. You're going to have that open higher or equal to the previous candle, and it will close higher, but not have a high. Obviously, we'll close higher. That's why it has to be a bullish candle, right? And we need to close inside the actual body of the preceding candle. And exactly the opposite is for the bearish harami. And then we got the kicker, bullish kicker. It forms after a downtrend. But as I said before, it's not always the case that we need to have a trend. It opens up the previous open, which is up here. It closes much higher, usually the distance of the previous candle at least, and we have no or very little small wicks. Okay, but it's very important that we don't go really like into that territory of the previous candle nearly like at all. Okay, now these are some general stuff about risk management so that you have a better sort of understanding when we're going to move into the strategies. And let me tell you this, candlesticks are quite effective in identifying entry and exit levels, whether profitable or unprofitable. Here's a common list. The previous candle's highs and what matters, right, for about exiting and entering. High and low, they open on the close, the range, and the body of the previous candle, the underside candlestick patterns, if any, size of the week after running profits, okay? Return to the signal candle. Can we get that? If that happens, we'll close the trade straight away. Indicators being overbought or oversold while upper or above the candlestick formation, okay? Now, this is the engulfing strategy, guys, okay? It, of course, involves looking for a rising or a falling trend that is followed by two non-directional candles. I mean, they have the opposite color. The first candle should be directional, as goes with the trend, while the second one, which is the signal candle, not, and completely engulf the body of the first candle. When the signal body engulfs more than its preceding signal's range, it is an indication of a strength in the reversal. Large volumes or gaps during the engulfing candle increase the likelihood of a successful trade, and it should be taken if all criteria are met. Okay, so the conditions are: the body of the signal candle must engulf at least the previous candle's body. Engulfing more than one candle indicates strength in the reversal. The direction of the previous candle must belong to a predominant trend unless it is a solitary signal, whereas the signal candle is the reverse candle. The bodies of both candles cannot be dojis or be short, otherwise the pattern is invalid. The last candle of the trend is preferred to be fast, it has no wick as this increases the profit take potential. Volumes must be larger or close to the previous candle, okay? Larger or close to the previous candle. Directional gaps below the previous candle's low increase the prospects. And the rules: works best on the daily chart. Use the stochastic indicator 80-20 overbought oversold. Uses the volume indicator. Pattern is valid when at least the previous candle is in overbought or oversold territory, so that needs to be the case. Entry is only if the volume is higher than the previous day in longs, but it can be also near to in shorts. positions. Okay, entries at the candle close or the 50 retracement based on your management. Target is 2x the previous candle's range. The take profit 1 and break even at 1x for the short term. Mid and opposite of the stochastic for the long term. The exit is just 5, well, the stop loss is just 5 pips below the high or the low of the previous candles. Close or reduce if the next candle shows slowdown. Move to break even when 1x is achieved. And here's an example. So where is the example? This is the pattern, guys. As you can clearly see it, we have actually come and done a fresh high. We have closed below the previous candle's low, okay? And this evident of a strong move, right? It's evident because it's very big, this candle, right? And we have had the uptrend as we expected. So let's look at those all ticked out. Number one, it's fully engulfed in the previous candle. Okay, we have the trend to the upside. That was the previous case, right? We have no small bodies or a doji. This candlestick is not a doji or has, you know, a small, even a wick. The preceding candle, which is this one, was in overbought territory on the stochastic, guys, which is very important. Okay, and we have a large signal candle as well with large volumes. You see, the volumes are larger than in this case, and the stop loss is 5 pips above the high of this of the signal candle. This is the entry, okay, which also is the break even. I will explain about this in a minute. The range of the candle is the first take profit, okay, the range from bottom to top of the take profit, the take profit one, and the second take profit is just 2 times the range. Okay, so if you use a Fibonacci extension, you're going to get 100x and 200x. Okay, now here's the trick. When you get to the take profit one, you have to move your stop loss to the entry. Okay, in that case, you have a free trade, and then you just wait for the market either to close you out, and you're going to make the take profit one. You should close 50% of your trade here, by the way, and then leave the rest for take profit two. Okay, it's how it works. Now the Harami strategy involves, of course, looking for a rise and a falling trend again. That is followed by 2 non-directional candles. The first candle should be directional, while the second one, the signal candle, not, and be completely engulfed in this case by the body of the first candle. When the signal range is engulfed by the preceding candle's range, it is an indication of strength in the reversal. Large volumes of gaps during the engulfed or inside candle increase the likelihood of a successful reversal trade. A successful trade may be taken as well when all the conditions are met. The range of the signal candle must be fully engulfed by the range of the previous candle's body. Okay, range, yes, but they are better when we have the body. If the range of the signal candle remains within the body of the previous candle, it is an indication for strong reversal, as I was just saying. A second inside candle increases the chance of a successful reversal. Okay, so if you get an inside candle and then another inside candle, it's more reliable. Any of the following candles must show weakness. The direction of the previous candle must belong to a predominant trend. The bodies of both candles cannot be dojis or be short, otherwise the pattern is invalid. The last candle of the trend is preferred to be fast and has no wick, as this increases profit take potential. The longer both candles, the more strong the reversal. The closer the inside candle to the opposite direction of the outside candle, the better. Okay, and rules pretty much the same as in the previous case, guys. Exactly the same rules for entering and exiting. The only thing is that the volume should be higher than the previous day. Okay. The example, of course, here it's looking at this particular case. We have the Harami, it's an inside bar. We have done no low and we have not gone below the previous day's close, which is good. We have gone up. We didn't go above the previous day's open, which is good. And we closed very close to that, which is also good. You know, we have higher volumes, and I'm going to show you that now because I'm actually going ahead of myself now. And there we go. It's fully engulfed. The previous trend was down, clearly, right? Typically, you can look at like 6 candles or something. There's no short bodies in either case. The preceding candle is in oversold territory, and we have larger volumes. Okay. As you can see, the stop loss is again 5 pips below the range of the candle. It's the first take profit, and the range of the 2x is the take profit 2. Actually, the trade closed here successfully. Okay, as you can see. Well, here, I would say maybe, yeah. Again, similar case, you move to take one, TP1, you take 50% of your trade off, and you move your stop loss to the entry, and then you let the rest run. You have a free trade and some money in the pocket. That trade, of course, just gave 155 versus the previous one, which saw, what was it, like 346. But let's just look the kicker now. It involves looking for directional candles with the same open. First candle should be directional. The second one should be completely reversing the body of the first candle. When the signal candles range does not enter the territory of the preceding candles range, is it an indication of a strength? With a lot of making, of course, the case even stronger. If it enters the body instead, the signal is invalid. Okay, we do not want that to see in there. Large volumes or gaps during the signal candle increase the likelihood of a successful trader and can be taken if the open of the signal candle must be the same as the open of the preceding candle, but in the opposite direction. A large signal candle indicates strength in the reversal. The direction of the previous candle does not have to belong to a predominant trend, as I was saying before, but it is better if the signal candle reverses in the normal oversold or overbought zone. Okay, the bodies of both candles cannot be dojis or be short, otherwise the pattern is invalid. Both candles are preferred to be fast and have no wicks. Think of Marubozus. Volumes must be larger on the signal candle, not on the previous candle. It can be tricky sometimes because you're not going to get all brokers revealing you volume information when there are gaps, and breakout gaps above or below the previous candles open increase the prospect. The rules are kind of the same. The pattern must appear when the oscillator has returned from OBS or OES, but very strong when it is in this territory. What means that the stochastic doesn't necessarily need to be overbought and oversold, but it is better if it is. Entry volume is higher than the previous day. Entry is a candle close, and the 50% and the 50 retracement is not always going to work because you're not going to have that going down there. But this is for those who want to take the risk. I personally don't want the 50 retracement entry because if price goes as deep as 50%, it means that I'm closing the trade. The target is 2x on both candles range. You see that? 2x on both candlesticks for take profit 1, and then you get another 2x, and then you go the 3 to the 4 for the long term, because this is a very big signal, guys. Okay, the exit can be at the high and the low of the preceding candle. Okay, depending on which direction we go. The close or reduce the next candle so slow down, move to break even when one exit is achieved. So, and this is the example. Should I just go straight to the chart that has everything? Now look at this. You have the open and the close at the same level, right? In both cases, the candles are large and they kind of look like Marubozus. One has a small wick to the upside, which is fine. Preceding candle is in oversold territory, and our signal candle has bigger volumes, and this is the perfect example. Okay, as in all cases, guys, I gave you the perfect examples, right? Look at this now. The first take profit is the range of both candles. This, okay, this is the first. And the moment you go to TP1, you close 50% of your trade and you move your stop loss to the break even, which is the entry. Okay, and this is the entry. Okay, or if you want, you can move your take profit to the gap here if you want. But then here's the thing: you let that run to TP2 by doing 2x, okay, of the range, and you close another 50% of what is left over, and then you let it run to TP3 and you leave another, and you close all the trade pretty much here. But this is up to you how you want to manage it. This is the way I do, but up to TP3, because this is a huge reversal signal, as I said before, 13% in one trade. Okay, and this is what is very important. It's very important. Now, some tips. First thing, we need to monitor momentum and the time of the day the pattern appears if you're trading anything below the daily. Okay, we don't want to trade it in Asia. We prefer to trade these reversals, well, London or closer to the end of the London, perhaps, you know, or maybe closer to the end of the Asian session, because then liquidity comes in London. But we need to always take into account support and resistance, trend lines, and other major swing levels, guys. Always, regardless of where, if your take profit is 5 pips above, for example, don't risk it. Just go to the support or the resistance. We need to confirm the pattern. Okay, the confirmation means, you know, with the indicators. Okay, it doesn't necessarily mean wait for the next candle. I showed you how I'm doing the confirmation, and otherwise you can enter a trade in anticipation of a move for larger gains. Because as I said before, sometimes people don't want to wait for the breakout. They just enter the trade. It's a bit more risky, obviously, because you don't know what direction the breakout is going to take. But if you have good evidence and you use all the candlestick information, well, and you're a bit more risk, your appetite is for risk is a bit larger, then go ahead. So in conclusion, candlestick pattern analysis can provide a decisive protection for price movements. Through pattern recognition, traders and investors can identify trends and possible reversals in order to help them make more informed decisions. Candlestick patterns can help traders identify potential entry and exit points, insights into their overall sentiment of the market, and a way to measure the strength of a particular move and its potential power. The top three candlestick patterns are the bearish engulfing, the bullish harami, and the kicker. The bearish engulfing is a strong sign of bearish momentum, while the harami indicates that a reversal may occur in the near future. The kicker also indicates that a strong trend may be coming and that a long trend could be developing. All three patterns can provide insight into potential future price movements and should be used in conjunction with other technical indicators for maximum success and minimum loss. By using candlestick patterns in conjunction with the stochastic and volumes indicators, traders can get an edge in their trading strategy, which can lead to greater success over time. And I do really hope that you were able to take advantage of the information here shown today. Now, if you have any questions, this is the last few minutes for you to go ahead and ask. But if you don't and you are looking at this recording, or perhaps you remembered something that you wanted to ask, you can feel free to email marketing@m4markets.com and leave a file for myself there, and I will reply to this email in person, if you have any questions. At the same time, let's not forget, guys, that it's a very, very, very important, okay, that we use all the conditions and the rules. The rules for the trade are pretty much the same in all of the sort of three different strategies, but as you probably remember, in under the conditions for each strategy, there are some minor differences, okay, and they pretty much come down to the characteristics of a candlestick, okay. And you remember the characteristics. This is where we are: the color, the body size, the wick position, the wick length, and the range. It's the first thing we need to know. Is the first thing we need to identify and to do in order to have a better idea of what sort of pattern we could be looking at. Is it reliable, or is it going to be just a minor? And the other thing is, of course, identify, evaluate, confirm, and manage, and then how to find proper signals. Where are we on the trend? What do the indicators show? Overbought, oversold? Are the volumes or not? Is there precedence in the particular, like previous week or so? Okay, and what happened? What is the post reaction? It's very important, this one. Can we get confirmation? If we can't, this is amazing. If we cannot, it's up to you what you want to do and if you want to risk it. And then, of course, if you trade anything below the 1 day, what time are you seeing the particular pattern? As a quick takeaway, let's not forget, we prefer to trade the reversals or the big moves when we are during London or heading to London session. Okay, so if you see a signal during Asia, it's not reliable. If you see a signal appearing just by the end of Asia, the opening of Europe of London, then that is definitely a much better case. So without further ado, I want to thank you for being with us today. This is Stavros from Info Markets. I hope you enjoyed this webinar, and I hope you find the insights valuable for your trading, so that you can also use candlestick patterns like I do.